And now, That Financial Guy with Keith and Jack Wilson, spreading a wealth of information.
All right, here we are. Second episode.
Oh, episode 2. We're rolling right along.
Second episode. My name is Jack Wilson.
And my name is Keith Wilson. We are the father and son financial dream team, a duo. We're actually practicing financial advisors. We run our own financial planning firm. And our mission with these podcasts and videos is to help you along your personal finance journey.
Yeah.
And things are going kind of rough right now with this stock market.
Yeah. So what we're looking at is a bear market.
A bear market.
If y'all don't know what that is, so a bear market is when the market drops by 20% from its previous high. And we're feeling it. Everybody's feeling it.
We are feeling it. We actually hit the bear market. If you're listening to this podcast later on, this is the year 2022, late October of 2022. And 2022 pretty much
sucks.
Pretty sucks. Big time.
Sucks.
So the previous high was January 4th, which was your birthday.
Mm-hmm.
So we went a high on Jack Wilson's birthday. Good for you.
Thank you for spreading that information.
Spreading the wealth of information. So we hit a high on the S&P 500 January 4th. Then we go down. We hit bear market territory in June.
Mm-hmm. Yeah.
And then July we started to pick back up, and then we doubled.
We're in the dumps right now. I mean,
it's starting to try to make a comeback.
Yeah,
but
we've seen it the last couple of days where it's just like tiptoeing back in.
It's trying its best. So we're also in a recession. Some people say, well, we're not really in a recession because.
Well, how long have we been in a recession?
Well, the first 2 quarters were negative growth, and there you go. That is the technical definition of a recession.
The definition has changed for some folks, I guess.
But technically, that is the true definition. 2 quarters in a row.
I keep hearing
in the GDP.
Yeah, I keep hearing, hey, we're headed towards a recession.
Yeah, that's the strangest thing.
We're definitely in it.
Okay, get ready. Prepare for a recession. We're already in it. So that's a recession, 2 quarters in a row, negative growth in GDP, bear market down 20% or more. At the production of this podcast, it's in the 22, 24%. In the S&P 500, that is an index. By the way, you cannot invest directly into an index. It's unmanaged. So there's our disclosure about that. So I want to talk about emotions. How are you going to handle this? Right. And emotions can get the best of you. And it just occurred to me a song. I'm not going to sing it.
Here we go.
But
Here we go.
I want to know if you know who sang this song.
All right.
Emotional Rescue. I can't even do it. Now, I'm not even going to try to sing like...
It would help if I
MJ was the singer of this famous rock and roll band back in the really 50s and 60s. They're still rocking and rolling.
MJ? What are you talking about, MJ?
Mick Jagger, man.
Okay.
Rolling Stones.
I love Rolling Stones. I've never heard that song.
Emotional Rescue. I hope I'm right on that. So let's talk about investing. And really, you got to get your emotions intact.
Yeah.
And your emotions can dictate a lot of bad decisions.
Whether good or bad.
Not only in investing. I mean, you think about all kinds of emotions. Love. I don't know if that's an emotion, but
I'll give you one.
All right. What's
kind of love?
What's that?
I just bought a puppy.
Oh, that's puppy love. Did you base that decision on getting that puppy based on your emotions?
Oh, yeah.
Who doesn't when they get a puppy?
I went to go look at him. I was not, I don't know. I wasn't really thinking that I'd get him that day because I wanted to do a little bit more, just gathering a little more information. But, you know how it goes as soon as you see.
Oh, you got to see that. What kind of puppy is it?
It's a miniature schnauzer.
Schnauzer.
It's a miniature schnauzer.
I've seen this puppy, and it's adorable, and I can see how your emotions could get the best of you there. But your emotions can cause sometimes rash decisions. I'm not saying your puppy purchase was rash, because that's going to be a long-term commitment, buddy.
Well, if we're talking about, your emotions running high, it's kind of it's kind of risky in the stock market.
Right.
We're talking about your money.
Well, if we're investing in equities, stocks, we all know going in, that's a risk.
Yeah.
You have a risk of, losing money, maybe on paper. And remember, you don't lose and you don't gain until you sell.
Right.
So the only way you're going to get hurt on a roller coaster is if you jump out midway through there. So you got to stick with it. So the two emotions in the stock market that can really ruin you are fear and greed.
Right.
And it works both ways. Fear, like we're seeing now, oh no, I'm going to lose every dime that I have. I need to get out right now.
That's very dangerous.
And greed, on the other hand, is like last year in 2021, man, we were rocking and rolling. And people said, I'm going to get more risk when they don't take their goals, their objectives, and how you can handle risk. And you don't want to go back and forth. So this is why.
And what's that Warren Buffett famous quote?
Oh, you got to be fearful when other people are greedy and greedy when people are fearful. So arguably the most successful investor is saying that. But this affects people's return on their portfolio if they're making decisions based on emotion. And I mean, we've got this statistic. I ran across this, and this was put out, let's see, FactSet said the average investor, and this was just the last 20 years, the average investor has earned 2.9% a year.
That's crazy to think about.
While the S&P, just in the last 20 years, not going back to 100 years, just the last 20 years, the S&P has averaged 7.5%. And that's with dividends reinvested and all that. Again, you can't invest directly into the S&P 500. It's an index. It's a benchmark. But that's alarming. The average investor, 2.9%.
Yeah, that's a little upsetting.
So why do you think that is?
Kind of going back to the emotional, putting your emotions in investing, because just like you were saying, when you're fearful, you want to take out, and it's almost like these some of the investors are trying to time the market.
People try to time the market. They say this thing's going down more, so I'm going to get out.
Yeah.
And so what could happen is you could get a big head fake. So if you time the market, you want to get out because you think it's going to go down even more. When are you going to get back in? And so what they're doing is they're doing opposite of true investing. They're selling low and they're buying high. So that's why the average investor, in my opinion, earns such a low rate of return compared to the benchmark. So you got to stay in it to win it. It's hard to say to people, hang in there. But first you got to start investing according to your risk tolerance, knowing that these things are going to happen. And I don't want to say I'm getting tired of this, but I've been doing this for over 30 years. And this is what I hear every time, every time.
Yeah.
Every time we hit a bear market or recession, folks are saying, well, Keith, I'm going to lose all my money.
Well, what's another famous one this time it's different?
That's the other thing I said. This time it's different. We've never had all these situations.
I'll give them one. I mean, I'm not siding with that, but we did just go through a worldwide pandemic, which some of the people that we have never,
I've never gone through that.
Right.
But I was telling folks back then, and even now, and you've heard me say this all the time, every event is different. Every outcome has been the same, which is the stock market has gone on to record new highs. So we've never in my lifetime.
And that's facts.
That is facts. That's history. That's history.
Yeah.
And so we've never gone through in my lifetime a global pandemic. I've never seen terrorists, fly airplanes into the Twin Towers.
Right.
We haven't seen that. Then in the 70s, the big oil crisis, and you don't remember because you were a figment of my imagination in the 70s, but I do remember the gas lines wrapped around, you could only go on certain days. And so
the internet was brand new too. You saw that.
In the 90s. Tech bubble, stock breaking. So people said this time it's all different. Yeah, every event's different. Every outcome has been the same.
Right.
You got to be in it to win it when it does come back. I ran across another historical facts.
Data.
So this goes along with what I'm saying about you got to be in it to win it. When recovery comes, it comes pretty quickly. So if you miss out on those days, and this is put out by Putnam, this little statistic, it was just going back 15 years. Mm-hmm. Over the last 15 years, if you missed 10 of the best days in the market, your average return would have been 5.05% per year. If you would have stayed invested, it would have been 10.68%. Now, I got to back up. This is assuming that you're directly invested in the S&P 500. And yeah, no, we can't do that. It's unmanaged.
Right.
You can invest in securities that mimic the S&P 500, but this is kind of goes along saying it. You missed 20 best days in those 15 years, 1.5%. If you missed 40 best days in that 15-year period, you would have had a negative average annual return of 3.5%. So this is saying, things do come back. It's not the end of the world. I want to say to people, do you really think you're going to lose all your money?
Yeah, and that would
mean every single company would have to go bankrupt.
I just had a young couple that came in, and they just started investing, so they've already seen, and they're aggressive, so they've already seen, what the market's doing. And of course, we go over fluctuation, especially with a aggressive model that we have. But they already came in, and they're like, so are we gonna? What is it possible for us to lose everything? And so we have that talk.
And this is. And
it's a big thing is diversification.
Thank you very much. So if we're putting all of our eggs in one basket, investing in one stock, one mutual fund, all right, let's just take an example. Let's pick your favorite stock. It doesn't matter. We're not going to mention names. But if you invested every single dime you had in that one stock, yeah. If that
company can go under, definitely.
No matter how big it is. That's why we spread it out.
Yeah.
Among different sectors, growth in income, fixed income, spread it out. That's what is called diversification. Now, let's back up and say this. Diversification, just because you're spreading it out, doesn't guarantee you success.
Right.
It doesn't guarantee you that your money will not lose in value. It is a strategy to minimize risk. So that is a strategy that we do. So, yeah, we've got all this data that suggest historically it's going to be okay. And we're trying to give people comfort in that. Another one I want to share with you is I looked back, or I didn't look back. This was a MSNBC fact set that going back to the crash of 29, all these market events since the crash of 29, all the, recessions, bear markets and so forth, the average bear market decline was 40%. And it lasted 1.3 years.
Average.
Yeah. So people think that it's going to last forever, number one. Number two, they think it will never recover. I've heard that. Oh, well, what is that? Tiger King that said, I'm never going to financially recover from this.
I think about how old the stock market actually is. And how many times we've seen the same thing.
We've all seen those charts from
the beginning of it, but
the very beginning. It looks like a straight up mountain. But if you look at just the 1.3 years of bad stuff, it looks really, really bad. And it is. I don't want to diminish that fact. But 1 year later, according to a fact set, 1 year later after a bear, the average return 1 year later, 48.74%.
Here's one thing that I bring up that's not in our charts or anything. When you get that in the mail, just don't look at it. Don't look at what's going on. I mean, you're going to look at it when it's high and.
Well, you're also you're going to look at it when it's down. You see the news and you see the media. That's called advertising, folks.
But that's going back to fear. That is going back to, hey, I'm going to call and say I'm too nervous to keep putting the money in. And
that's the best time.
But anyway, but that's when we talk people off the ledge.
When we see the news during these turbulent times and volatility, they're selling advertising.
Right.
Is all they're doing. And they want to make it as bad as it seems or it sounds, and they want you to tune in. There's an old saying in media, if it bleeds, it leads. So blood sells, and blood on the market and so forth. So let's give you some hope, and let's give you some ideas of how to overcome your emotion. That's what this is all about, emotional investing.
Right.
So how do you do it? One idea is, don't look at the TV every day. Don't look at your statement every day. It's going to get better. Every storm runs out of rain.
You're going to hear when it gets better.
Yeah. And the main thing is don't panic. There's a difference between reacting to something and responding to something. If you react, that's emotional, that's a rash. Think about it. How many times have you regretted saying something or doing something in the heat of the moment?
Oh, yeah.
Oh, I shouldn't have said that. I shouldn't have done that. So that's a reaction, whereas a responding...
That's why I have so many ex-girlfriends.
When you're responding to something, it's more deliberate, it takes consideration, and it takes thought.
Yeah.
So don't panic.
If you're a investor that's doing it on your own, take a look at the portfolio too. I mean, you might not be diversified, and I say to those people that are doing it on their own, if you have a financial advisor, we hope that your portfolio is diversified.
So to begin with, when you start your investing journey, you should invest according to your risk tolerance. And usually, it's not always, but usually the younger you are, the more aggressive you're going to be. And I should say, if your time horizon, when you need this money, is way on down the road, 10, 15, 20 years, nothing wrong with being aggressive. And yes, so what? It's going to go down for a little bit.
Right.
But what you're doing is you're taking a risk for that potential reward. And historically, we've just shown you that reward has historical method to it.
Right.
So invest according to your risk tolerance. On the flip side, when things are really, really good, don't try to get more aggressive if you can't handle
Going back to fear and greed.
It's easy to say, man, I want to throw more money. I'm only making this much.
You got to stick to what you're comfortable with.
What you're comfortable with, feeling that risk tolerance. So assess what is in your portfolio. Maybe you picked a security or two that was kind of speculative and it didn't work out the way you want. Let's look at the outlook of that one company. Maybe you need to reassess and rebalance. But the diversification, again, is a powerful thing to minimize the risk. We invest in quality instead of speculation.
Oh, yeah.
There are certain securities that are very popular that we say no.
Right.
Because it doesn't have a proven track record. And
I think that's the number one thing we look at. I mean, we've all heard of big companies coming out, and it does look flashy. And
it looks flashy, and the charts are all over the place. But
you got to look at the data. You got to look at the history of it.
I mean, is it something of merit? Is it something that has a future value to it? Or is it just super speculative and I want to play with it? Nothing wrong with play money.
Right.
As long as you can invest dollars that you're willing to lose all of it. You certainly don't want to do that with your retirement account.
That's all about risk.
So working with a financial advisor, that's one thing that helps kind of coach you along the way, that can give you some perspective. But mainly know your history. We just quoted it. Time and time again, history shows that the market has always recovered to new highs. No, it's no fun to go through this, but let this be a lesson. Were you invested more aggressively than you should be before this happened? I mean, I have it all over the place where, well, you know the gentleman, I'm not going to mention his name, but it was just the other day, we're sitting in the meeting, he says, yeah, I don't even need to look, I know, but I got 20 years.
We like those people.
Before it comes, they know their history. So now's the time to reassess that. Were you invested too aggressively to begin with? And maybe there's opportunities in all of this.
Yeah.
So here we are. We're almost a full year into this.
I mean, let's look at the positive side, though, is everything, like we were talking about, everything's on sale.
Yeah. When's the last time that you had your eye on something I don't know, sneakers. For me, it's probably camera equipment.
Yeah, it's probably like sweater
vest. Yeah. So when's the last time you had your eye on something and all of it, you said, I'm going to wait until it goes on sale. And then it's 20% off and you say, oh, no, I don't want that. No, you do that. So this may be the time to put together a shopping list.
I mean, we can look at
of good
some
securities
positive things here right now.
that have. So I think I can't predict it. Nobody can. If I could, I wouldn't be here. But I do think the worst with this current downturn and bear market is behind us. I'm not saying we're out of the woods yet. Volatility is always going to be there. But I'd stay the course. Take these examples of what we're talking about, reassess where you are, reassess your risk level. And there were certain people that just here recently who called and said, shouldn't we get out?
Quite the opposite.
It's too late. It's too late.
Yeah.
Remember,
because that's when you're actually losing money.
That's when you actually lose money. So I did have one client in the height of the pandemic in 2020, from February to March 23rd, the stock market went down something like 40%. It was the steepest, quickest decline in almost history. And it was on March 23rd of 2020. And I've had previous conversations with this person. She said, no mas, I'm out. I don't care, Keith. I'm going to wait until it goes back up, which is kind of silly to say. That was an important date because March 23rd was the bottom. So from April to August in that year, the market fully recovered and then went on.
And you were talking about, all right, you're not technically losing money. You're losing on paper.
It's on paper.
When you're getting out in times like this, taking all your money out, then you're losing that money.
But again, just to summarize, reassess where you are now. It might be a good time to rebalance. Look at what you own. Does it still fit with your goals and objectives? Manage those emotions. Don't look at it every day. This too shall pass. Data after data shows that it's going to be a sunny day. Of course, we can't guarantee that, but we've got 100 years of history that kind of proves otherwise. But I know it's tough. Manage those emotions and remember to respond rather than react. I think that's it for episode 2. Folks, hang in there. Like I said, it's going to be a sunny day on the backside of this thing. And we will continue to do this about every 2 weeks. Please subscribe, follow, helps the algorithm so we can get this information out there to you. Take care. Have a great day.
Peace.
Thank you for joining us on That Financial Guy. For more information, get in touch with Keith and Jack at wfa-nc.com. Remember to subscribe to the podcast to hear more information to help you pursue your financial goals. Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA/SIPC. The options voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. This information is not intended to be a substitute for individualized legal advice. We suggest that you discuss your specific situation with a qualified attorney. This information is not intended to be a substitute for specific individualized tax advice. Please seek a professional tax advisor.